Well, let's get some more perspective on the fixed income markets now. And joining us from Hong Kong is Greg Peters, Co-CIO for Public and Private Fixed Income at PGIM. Greg, thanks so much for joining us today. And I do want to kick off with that data that we saw out of the US, the ADP November payrolls slipping. Pretty much seems to be the consensus that that's nailed on a Fed rate cut for next week. But what kind of commentary do you expect to hear now around further easing?
Yeah, so I do think, we will have a hawkish cut, coming up. But I'm not sure there's a lot of information coming out of that meeting, right? I think the markets are focused on what happens next. And what happens next is the new Fed chair, the new composition, and quite candidly, the meddling of the administration in Fed affairs. So I'm not sure there's a lot you can read into next week's meeting. But the labor market has been softening. It's been stagnating for quite some time. You saw that in spades yesterday. So, on one hand, you have a weakening labor market. On the other, you have stubborn inflation. And our read is that inflation is going to actually be much more stubborn going into 2026. And that really complicates matters for the Fed and complicates matters for, financial markets writ large.
Well, in terms of 2025, we've got US Treasuries heading for the best year that they've seen in 5 years. But with the picture a little bit more interesting for 2026, how do you see this trend evolving?
Yeah, so if you decompose what has done well on the Treasury side, it's not the back end of the curve. So what has been happening is that even though Fed cuts have come through, it's pulled the front end lower and the belly lower, but the back end is actually trading higher today than it was this time last year. And so why is that occurring? Because investors are worried about this inflation component. They're worried about Fed independence / credibility. And so risk premium, term premium is being built into the curve, not only in the U.S., but across all sovereign bond markets. So it depends where you are. The bond market in the back end is still quite fragile.
Greg, I just want to get your views on Fed independence as well. We've had a report in the Financial Times today about bond investors warning the Treasury about the risk of Kevin Hassett, should he be the next Fed chair, of pursuing easing for political reasons. I'm wondering if you'd add your voice to that warning, but also, when push comes to shove, is the bond market going to make sure the Fed stays independent?
Well, I sure hope so. So, I mean, the market has reacted since the betting markets have, raised the probability last week. The bond market has performed quite poorly. So the bond market's telling you that there are some concerns there. But on one hand, you have the Fed independence question, with Hassett as, basically tied to the administration. But on the other, does he have the credibility within the committee to drive consensus? And so we don't know that answer. I don't think he has that credibility. I think that's what the bond market is telling you. But it's important to remember that it's a full committee, and you have to have the confidence of the committee to drive consensus, and I don't know if he has it. But one point on that, though, I think there's a lot more to come on the Fed side. I think the Fed chair is just one aspect. I look for, some other structural changes on the come from the Fed that actually whittles the independence even more than just having a different Fed chair.